Thanks everybody for joining us this morning. Sorry we're a little bit late, but we've obviously had a lot of people that have wanted to join the webinar this morning, so we're hoping to get as many people in as possible. For those of you who don't know me, I'm Lisa Wilson and I head up the tax team at Cowgills, and this morning I'm going to be joined by a number of my colleagues across our business units who are all going to have a contribution into how they feel the impact of the recent budget will have on our business as well as yours. I'll introduce them as they come to speak, or they'll introduce themselves. I'm sure by now you've had a chance to digest some of the headline grabbing measures that were introduced by the Chancellor last Wednesday. As part of today's briefing, I'd like to give you a round robin of the measures that I think our clients will be most interested in, cover off how we at Cowgills think you might be able to insulate yourself from some of the tax rises that have been announced, and cover off some of the questions that we've had in from some of you ahead of today's seminar. So let's get into the detail and we'll try and cover off as much as possible in the time that we've got. So I guess the least surprising measure that was announced in the budget was the increase in capital gains tax. It was no secret that CGT was in the line of sight of the Chancellor, which has really fuelled M&A activity, certainly for us over the last 6 months, with lots of clients trying to get deals over the line before the budget deadline. So it wasn't necessarily a question of if it would change, it was more about a question of by how much and the timing of any increase. And the end result, the actual announcement from Rachel Rees was a little surprising, but also quite clever. So if I bet against the majority who thought that it was all going to change in April 2025, I would have been half right, but I also would have been quite happy because the next 6 months would have been just as busy as the last 6 months in terms of getting significant amount of M&A deals done before the deadline. But what the Chancellor actually did was mostly change the rates immediately. What I mean by mostly is that both the lower rate of CGT changed from 10% to 18%, and the main rate of CGT also increased from 20 to 24%, but she had a different strategy for business asset disposal relief. So rather than make changes immediately, so increase the rate of 10% on the first £1 million that qualifying individuals have when they sell a qualifying business asset, the Chancellor actually tapered the change. So ahead of April 2025, you'll still benefit by the 10% tax rate on qualifying gains. After that period, for a year, between the 6th of April 25 and 5th of April 26, your first £1 million of gains will be taxed at 14%. And then after April 26, it's going to be at 18%. So if I just do a quick example of what that actually means in practice, before budget day, on a qualifying disposal of shares in a company of, say, £5 million, it would have resulted in a tax liability for an individual of £900,000. So a sale after budget day, but before 5th of April 2025, the tax liability is now going to be £1,060,000. So there is a difference of £160,000 from what if you'd done your deal last Tuesday. If your sale takes place between April 25 and April 26, you're going to pay a CGT of 1.1 million. That's a difference of £200,000 from last week. And then if your sale is after the 6th of April 2026, you're going to pay 1.14, so a difference of £240,000. So if you are considering selling your business over the next couple of years, you might want to think about the timing, as each April that you lap, you will be liable for an additional £40,000. Pre-budget, we were aware of a number of pre-tax planning measures, including putting in holding companies and disapplying share-for-share relief, which would fix gains at pre-budget date. it would mean that you had a dry tax charge, but you were comfortable if your deal was imminent, and then if your deal didn't happen, you could possibly fall into the relief anyway. This was counteracted by some anti-avoidance measures. So if you've done that, then that planning will be ineffective. And we cautioned against that measure because we'd seen this before. We'd seen retroactive legislation like this with when BADA entrepreneurs relief changed to business asset disposal relief, and it dropped from 10 million to 1 million. So we knew that the Treasury were probably likely to try and counteract anybody that tried to be too clever, that didn't really have a real transaction. As part of obviously our invitation to clients today, we'd asked clients if they'd got any questions that they'd like to specifically for us to deal with. And we had a question from a client that stated that I'm unlikely to get a deal done before April next year. Are there ways that I can look to mitigate my tax on the disposal of my business? And before I respond to that question, I'd like to bring in James Kennedy, who is a partner in our corporate finance team. James, what is your impression of how these changes are going to impact on the deal market, specifically, obviously, given that we've been crazy busy for the last 6 months? Do you actually think that a 4% capital gains tax change is going to make that much of a difference to the activity? And how do you think the changes are going to impact on value?
Thanks, Lisa. Good question. So I think the first point is in the build up to the budget, which I've never seen anything like that before in terms of the eagerly anticipation of it coming forward. I think all the rumours had circulated, and I'd heard everything from in line with income tax rates to 24% and everything in between. And I was once told some advice that if you're going to deliver some bad news, give some worse news first, and anything after that is a bit of a benefit. So I think there was a lot of shareholders that were fully expecting the rate to go up. It was a case of how much. And I think if you were fearing a 39%, for example, one of the rumours, rate of increase or rate of CGT, I think a lot of them will have come away thinking that 24% and no change in BADA initially is about as good as they could have hoped for in the short term. So I expect not a significant change. I don't think there'll be suddenly a delta of deals in the market. I actually think it was quite smart, as you say, that there will still be activity and there'll be people that will want to try and do a deal before April 25 or before April 26 for that change. I don't think there will be a massive change on multiple or deal value as a result. It wasn't significant enough change. I think on our deals, there hasn't been, touch wood, there hasn't been a deal that has radically changed as a result of last Wednesday. There's been some tweaking of deal structures to try and possibly cash out a little more than they were before to try and get to the same result. But overall, it's been business as usual. And I think that's because the rate change hasn't been as severe as perhaps people feared. In terms of planning ahead for April 25 or 26, it'd be the same advice as I'd give to any client, irrespective of the tax, is if you're planning a sale before April 25, between now and then, it's not a lot of time, and most deals are taking longer than previously. It would be all about the preparation that you do now to make sure you've got a data room fully populated, that your legal advisors are on board, that your financials are in good affairs. Those are the real factors that slow down a deal. And I think if you haven't got those in place now and you're not in exclusivity, you're going to really struggle to be before April 25. I think more likely I've got clients that are, the last two conversations I had are people that are keen to sell, but they're now trying to sell before April 26. And they'd rather have a bit more profits and the growth journey and know they're not going to get there by then, and they've earmarked sort of Q4 for next year.
Okay, thank you. So it sounds like the 4% change isn't necessary. Might sort of make people consider sort of timing, but it's unlikely they're going to get anything done before April. But presumably, you know, a lot of our business will sell on a cash-free, debt-free basis, and therefore, if you've got an extra year of profits, it probably negates the additional 4% in any event, I'd say.
Yeah, yes. I mean, the two I mentioned, they're both growing by 20% a year. So trying to do a deal now to force through before April doesn't actually work in the overall potential proceeds for them.
Okay, good. Thank you, James. As I mentioned, there are other measures that owners can consider in order to sort of mitigate gains. So the question, are you able to mitigate them? You know, yes, it's always possible to mitigate gains if you've got enough sort of visibility on sort of your transaction. With anti-forestalling that I spoke about earlier, about people putting in holding companies, that is something that we've seen a lot of, not just driven by the budget, but driven by a lot of our clients being sort of multiple business owners, and a lot of the time they will have a holding company with lots of companies underneath that they might buy and sell, and they use a holding company in sort of in order to sort of recycle. But if you're not planning to sell your business within a sort of 4-year window and want to shelter some of those gains, you might want to consider using holding companies to try and sort of ring fence value and wealth, and using things like family investment companies. For example, if I have a company, a client who's got a holding company with 100% owned sub, and they're planning to dispose of it, if the sub has been held in this structure for over 12 months and it's a qualifying trading business, if there's a sale of the shares of the sub rather than the sale of the shares of the top company, the transaction could potentially benefit from substantial shareholders exemption, and then all of the proceeds from the sale of that disposal of sub will end up in the holding company completely tax-free. Yes, they're still enveloped, but it's a way maybe of managing the timing of any tax hit. James Greenhalgh, who's a partner in our tax advisory team, has undertaken a lot of structuring for clients when they're either recycling money, when they're buying and selling multiple businesses, or when looking to ring fence value or large in assets such as property. James, can you briefly discuss how looking at a group structure rather than a standalone company might be beneficial to clients, and how tax surplus cash, tax on surplus cash can be mitigated for me?
Yeah, it's typically used in situations where there are either different businesses knocking about, or in the case of property developers, specific developments that, not just for tax reasons, but for commercial reasons, people like to ring fence particular deals in particular companies. And if you just do that in single companies, then you've got an issue then with what to do with the cash on the profits. There'll obviously be corporation tax payable. You can't get around that. But having a holding company that sits above those individual special purpose vehicles or individual trading companies, that allows you to get the profits from the SPV up into the holding company, and there's no tax on that other than the initial corporation tax that was paid on the profit. And then you can drop that cash back down into new ventures as you go along. And as long as you don't extract any monies, then there's no further tax at that stage. Obviously, if you need some cash as an owner manager for day-to-day living expenses, you can always declare a dividend or a bonus in the normal way. And yes, you'll have to pay your income tax, but it's a very efficient way of recycling profits from individual ventures. With an eventual exit at the end. If you've finished everything, then you can either do a last sale or sometimes a solvent liquidation. We saw a lot of those up in the run-up to the budget.
Yeah, so that's probably something for you as well, John. Obviously, again, as well as the deal market going ballistic for the last 6 months, obviously, I think you guys saw an uptick in members voluntary liquidations, those liquidations obviously where people are looking to exit, and instead of selling the business, maybe close the doors or sell everything and then release the cash. Is that something that you think, is that a trend that will continue, or do you think that there was a bit of a furore with people trying to get things out pre-budget and now it will settle down a bit?
Yeah, I think we always tend to have a spike pre any budget for obviously the fear of CGT being increased. I think that's happened sort of year on year. This particular budget spiked everybody's interest, obviously for obvious reasons. It was the longer-awaited Labour budget for 14 years or whatever it was, and obviously as James has commented on, there was a real fear that capital gains could just completely fly up the scale. So we were very, very busy. We actually got to the point where unfortunately, because of the level of work that we had a specific cut-off point that we just weren't able to take any further engagements on, because we wouldn't be able to complete the ones that we had. So I think that the thing is, when anybody has a deadline, it sort of always focuses the mind, as it were, in relation to, well, we have to do it by that particular point, which obviously, the budget seems to be, sort of the real sort of flag in the sand, as it were. But in an ideal scenario, you want to be, having some proper advice on the way through, and doing it when it's right for you, rather than when you feel you need to do it. So really that would be my advice, proper tax advice, both on your personal and your business side. Get everything where it needs to be, and then you control the timeline rather than being pushed to do it because something specific is going to happen. I think in this particular one, it did push everybody to do it, or a lot of people to do it earlier than they'd sort of anticipated. But again, the surprise was, when it only went up to 24%. Now I know it's a 4% rise, but as James intimated, we were looking at a risk of it being 30 plus.
And that's a really important point, I think, because I was speaking to somebody yesterday, and I said when I first came into tax, CGT was 40%, and all of my clients at that point would have given their ITs for it to be 24%. So there is a lot to be said about acting when you've got certainty rather than pushing up against that deadline, because obviously things get a little bit frenetic when people are trying to do something before a very sort of hard deadline like a budget. And I think that's not only just about when you're selling your business, but also thinking about financial independence. What we didn't see in the budget, and which I'm still sort of waiting for a second boot to drop, is there's obviously been a lot of talk, and there always is a lot of talk about how dividend rates are very different from income tax rates, and I will come back to sort of the variable on that a bit later on in our discussion. But there is, people have, because of advantageous tax rates, tended to keep money in companies. And I'm a big proponent of sort of financial independence, which is actually don't leave things in pots, don't allow money to sort of sit in places where, particularly businesses, where it's at risk, isn't it, John? Because, if something happens to the business, then you've built up significant cash proceeds in the business, and then something happens to the business, obviously they're in the mix as well, and there's no means by which that individual shareholder can salvage that cash once it's in a process.
Yeah, indeed, and businesses fail for lots and lots of reasons. It can be a slow, steady drip in relation to the profit margins are eroded, and you're just basically using your capital to keep afloat. But there can be sort of one-off instances, completely, unseen, where it completely knocks the corporate entity, off course, and then you're left with having to trying to maximize your recovery as a shareholder, but ultimately subsequently what may happen to that entity if it, heaven forbid, if it has to go through an insolvent process. You've then got the likes of us as insolvency practitioners then looking to unpick any transactions that have happened prior to that. So I completely agree, Lisa. If you've got the capacity and wherewithal to get control of essentially your asset, because that's ideally what your business should be, and then utilize it through proper personal tax advice, I would always suggest you do so.
Yeah, great. Thanks, John.
Lisa, sorry, Lisa, that's an insolvency practitioner extolling the benefits of a holding company there. So you've heard it from the horse's mouth there.
Yeah, without a doubt. Yeah, I'm actually advising one particular entity at this moment in time, and there is a holding company alongside, so we'll see how that pans out.
Yeah. I think actually that is, that message has always been key for us and our clients, which is actually making sure that you've got things ring fenced, that actually from a personal perspective, but also from a corporate perspective, that you are managing it. You're not being passive in terms of managing your assets and managing your cash. And one of the things that I wanted to come back to is obviously from a CGT perspective, if you are a sole shareholder and all of the tax is going to sort of befall on you, one of the things that people might want to think about is actually sort of spreading some of the shareholding around. So instead of it just being on one person, maybe look to transfer shares to spouse or even adult children, particularly where those people legitimately work in the business. And then we've got an opportunity maybe of £1 million for 4 people at my 18%, 10 to 18%, or rather than just sort of stick with one. One of the things as well that also achieves is it spreads wealth across the family rather than just concentrating it on one person. And obviously, one of the other massive areas of change in the budget was surrounding IHT generally, but also for our clients, the huge impact that the changes will have on business property relief. And I'd like to bring you in here, Michelle. Michelle is the director in our private client team and deals with all of our trusts and sort of family wealth clients. This was quite a big shock, really, Michelle. I know from all the budgets that I've done, we always talk about business property relief being changed. And one of the things that I had anticipated was that actually they'd remove the double bubble, which was a tax-free uplift at death on shares and then them being exempt for IHT. But they changed it in a completely different way than what I was expecting. Do you want to just pick up on the changes?
Yeah, I agree. Yeah, perfect. Thanks, Lisa. Yeah, I think it was always also a surprise for everyone, I think, for them to cap it at £1 million, like straight away. But obviously there was significant changes to the scope of business property relief and agricultural property relief. Obviously, currently 100% relief is available from IHT on obviously trade and business interests and indeed certain holdings of agricultural land and property. But with effect from 6th of April, there is a cap on that, and a new tax-free allowance of £1 million will apply, and that's to the combined value of any property that qualifies for business property relief and or agricultural property relief. So any value exceeding that £1 million allowance would be taxed. It would benefit from a 50% relief only, so it would have an effective rate of tax at 20%. So just to put that into context, if you've got a sole shareholder with a £1 million threshold, ultimately, if they've got a business worth £5 million that qualifies for BPR or APR, and then ultimately they're going to look at having a tax liability of circa 800k, which obviously wouldn't have been the case and won't be the case pre 6th of April. The £1 million allowance also applies obviously for property held on death, so business or agricultural property, lifetime transfers, so obviously where those transfers, you've transferred business property to an individual and they're going to become chargeable if you've passed away within 7 years of the date of that transfer, or indeed if there's been a transfer to a trust or a company. So it is going to capture, obviously, and the £1 million allowance will apply to all three of those circumstances. They did bring in some anti-forestalling provisions, which means that obviously any gift or transfer made after 30 October, so the budget day, and someone passes away before 6th of April, will see those new rules apply. So obviously that's key. Presumably lifetime transfers made before budget day will continue to benefit from the old rules, but that detail needs to be confirmed. So we're not sure on that point just yet. It was also obviously announced that the rate of relief for AIM shares, or for quoted shares listed on the AIM market, are obviously also going to be removed from the IHT free net. So they're also going to have that 50% reduction. So ultimately a 20% tax rate from 6th of April 26. And they're also not going to contribute to the £1 million allowance. So they're going to be on top of that.
So one of the key that we do, obviously, with corporate finance is pre-deal. We will always have a lot of clients where they're financially independent anyway. So one of the things, obviously, that we've spoken about is possibly putting a holding company in order to sort of ring fence that value, but it doesn't take it out of the estate. And one of the things in more recent times that we've done is actually we've looked to transfer shares into trust pre-deal in order that we managed to stuff in more than £325,000 into a trust and start the clock ticking in terms of the estate coming, that value falling out of the estate. Are trusts still viable in that type of situation? Is there something that clients should be thinking about in terms of transfers earlier, or how do you manage that transfer of value now outside of an individual's estate?
Yeah, so the new rules do apply to trusts as well. So they are going to have that £1 million allowance that's going to be introduced from 6th of April. And there is going to be some anti-forestalling provisions again brought in from a trust perspective, so that any trust settled before 30th of October will be okay and have their allowance, but any trust settled thereafter will be restricted to the £1 million allowance. We have obviously done a lot of trust planning for clients with regards to transferring shares that qualify for business property relief in, and it is still a valid exercise. There is obviously an allowance to be used post 5th of April, so you can still always look at that £1 million and put that in. And just to quantify, that's £1 million for husband and wife or every shareholder. So, obviously, technically, if you've got a married couple, 2 million can still go into trust. But ultimately, in the interim period now, there's obviously, if clients are talking or considering about selling their business, and obviously this goes back to what James has just said about whether that's possible, then obviously that cap doesn't apply until 6th of April. So if there is that business sale forthcoming, then obviously up to 6th of April, you can still put in anything over and above that £1 million to avoid any entry charge. So obviously there's an inheritance tax entry charge over the nil rate bank currently, but if you're putting a trading business property in, then there's not, and that cap of £1 million doesn't apply until 6th of April. So trust planning is still effective. It will be effective now up until 6th of April, and it will be effective post 6th of April. It's just obviously the limits to that will obviously be affected.
Yeah, okay. One of the things I was just thinking as you were talking is obviously if people don't necessarily have a sale on the horizon but are looking potentially to release some funds, there are obviously different ways, not necessarily a sort of third party purchase. So one of the things that I was thinking of, whether it would sort of fuel maybe management buyouts or partial sales of shares where there might be cash in the business that could be used or that it could be financed. And obviously, Ben, you and I have done quite a lot of MBOs in the last 12 months in any event where there's been some liquidity in the company. There has been a desire for either a partial exit or a full exit to either a management team or, in some of the cases that we've dealt with, family businesses where they're transitioning to children. Obviously, it has been the case in the past where you've been able to transfer those shares free, but we've never advised that, have we? Always think that it's a good idea that actually mum and dad get the value out of the business that they should, and that sort of unfetters the kids really to go forth and do treat the business as it is their own, which is, tends to be better in terms of productivity. How, for you, Ben, how is the budget been in terms of, do you think there's going to be an impact on the sort of lending market? And are you anticipating that you're going to get more sort of inquiries about releasing, funds from businesses or leveraging assets in order to sort of buy out majority shareholders or partial exits?
Yeah, thanks, Lisa. As you mentioned, we've done a number of partial MBOs and EOTs recently, and I anticipate that to continue. There's plenty of liquidity in the debt market, and the early noises are that's going to continue. I think one thing that is a positive on those types of transactions is because they are, let's say, a bit friendlier, the legals can be a lot quicker. As James Kennedy mentioned earlier in the call, one of the things that slows deals down is the legal process. Well, if you're doing a partial MBO to a family member or management team, the legals can be turned around an awful lot quicker. I mean, we completed one pre-budget in about 6 weeks. We've done some EOTs recently where obviously you guys play a big part in the tax side of things, but we've got a good, well-formed process to deliver those. And in actual fact, the last EOT we did was actually funded by a high street bank. So it shows sort of there is sort of plenty of liquidity in the debt market for these types of transactions.
And that is, EOTs and EBTs were mentioned in the budget really briefly about some consultation, but actually, particularly with EOTs, the rules still stand where actually you could sell your business to an employee ownership trust and your tax rate is 0. So, which might be more of an incentive given, the increase in the rates. And the sort of, tapering down of business asset disposal relief. Obviously, the EOT needs to be done in the right circumstances. Where I'm sure there's been lots of sort of transactions which possibly aren't particularly suited for EOTs because obviously they're quite restrictive in terms of the actual benefits to the employees. And if you only sell partial sell, your only other buyer for your minority interest will always be the employee ownership trust. And also, it's still quite punitive if that business then wants to go and sell in the future. Once it's in an EOT, it's pretty much locked in an EOT. But if you model yourself on John Lewis or Richard Sounds, and certainly we've got some clients who are very altruistic and they do want their employees to benefit significant from the disposal of the business. EOT seems like quite an attractive offer.
Yeah, and I think because of the complex nature of them, there are a number of lenders, number of mainstream lenders that just won't touch them because of the reasons that you've mentioned. So as I say, it's knowing where to go for the right funding solution.
Yeah, in most instances, I guess though, for our businesses, we tend to sell them and sell them externally because that's where we get the primary value.
Yeah, I mean, I think we have seen a bit more of an increase in partial MBOs, and there are a number in the pipeline that have also been sort of waiting on the budget. And I think that CGT going up and the business asset disposal relief remaining where it is, I think they will start to push the button, and they're the deals that we can certainly get done before the end of April again. Because the legal process, it's a friendlier transaction, so the legals are generally a lot quicker.
Obviously, you mentioned that that's quite a friendly transaction, and in some respects, what the sort of help that we give to people who are considering an EOT is we'd always recommend that they do a valuation. in order that they can support the price. One of the things, Sam, that you and I have been speaking about is how the increase in CGT affects the perception of the buyer of what their market is to sell, and whether, you know, James and I were just talking about, you know, whether they hang on for another year, or how we feel that buyers, you know, are they going to be intrepidous about going to market now because of the tax regime, or are they still pretty comfortable that they can get the values that they want?
Yeah, so I think it's a very interesting inflection point if you're in a buyer's position. I suppose we pride ourselves with trying to understand both mindset of a vendor and a buyer as you go through a transaction. So uncertainty has certainly caused a lot of problems for buyers. There have been very few trade buyers, but if we were to look at our portfolio of clients at the moment, the vast majority of deals we're doing are trade. I think trade has woken up to the fact that there are some frustrated vendors that have missed out on a deal in the last 18 months because the economic environment's not right. They've probably been very worried about tax changes that have happened and are probably not very trustful of the government, that there won't be another change in CGT that's not there. And so whilst I think we've got some stability, I think from a buyer's perspective, there's a little bit of opportunism. And so I think you're going to see a lot more inquiries. We're certainly being approached by a lot of private equity backed acquirers and some larger trade buyers that are looking to do, you know, multiple acquisitions in kind of core sectors. And then we've also got a very interesting, a very interesting confluence of 2 points coming across, which is that fear, and it's not just a fear of tax rates going up, it's a fear of missing out on a deal. And I think that's what starts to drive that. And when buyers pick up on those signals, I think they come to the market. James was spot on. I don't think prices will shift. I think if we'd had a 10% movement in CGT, we would have seen a 10% uplift in pricing for 12 or 18 months before it returned back. I think 4%, people are saying, look, that's just a year's worth of interest you receive. The more critical factor alongside that fear of loss or fear of missing out from a vendor that buyers exposed to is actually, and it's the story that wasn't really talked about, is the fact that interest rates have plateaued and are on the way down, and nothing fuels the M&A market quite like reducing interest rates or stable interest rates, because people can price in their capital. And actually, if we see interest rates drop a little bit, I do think there'll be some more margin in pricing, and we'll see certainly the slightly more marginal valuation deals, people willing to put a bit more on the price, so go from 5 to 5.5 times EBITDA to try and get that deal done. And that's just an interesting opportunity. So much the same as James always say, you've got to sell your business when you're ready. You've got to get yourself into the right headspace to be able to do that. You've got to do your preparation. But we always give one piece of advice to our clients, which is if we tell you now is the right moment to sell, then you kind of got to listen to that advice, because we understand what's going on in the buyer market. And we're predicting a reasonably buoyant 2 years coming as lots more buyers enter that market.
Yeah, thanks, Sam. So I'm just conscious of time, and I want to move away maybe from those people that are considering sale to those people that aren't, and what the budget means for those people in terms of profitability going forward. One of the most significant changes was obviously national insurance contributions. We didn't have what we feared, which was national insurance imposed on employer pension contributions, which would have just, I think, would have been a terrible idea. But there was a double whammy for business who employs staff, as obviously not only the Chancellor increased the rates on employee national insurance contributions by 1.2% from 13.8 to 15, but also dropped the threshold which employers' national contributions are payable from 9,100 to 5,000. So more of the salary of your team come into charge, and obviously at a higher rate. This obviously represents quite a significant cost to people, businesses like ours, where those businesses that have a national insurance bill in excess of £100,000. Obviously, if you have a national insurance bill of less than £100,000, you'll benefit from the employee allowance relief. and the relief for that increased from 5,000 to 10,500. So small businesses were largely protected, but there was definitely some disgruntlement from some of my clients that employ a lot of people. And obviously, as we all know, in people businesses comes quite a lot of risk. Labour's suggestion that this was not a tax on working people was obviously widely rejected, not just from the business community, but Paul Johnson at the Institute of Fiscal Studies. He also stated that it wouldn't raise the £25 billion that the government was predicting that it would, because in effect, by increasing that rate, it would have a stagnation effect on wages, and that would impact on the tax take, not just national insurance from employer contributions, but employee contributions, because obviously salaries would not increase in the manner in which they had done recently. And actually, wage stagnation is a real problem in the UK. There was obviously also a £6 billion chip on that 25, because the government's obviously promised compensation to public sector employees to mitigate some of the costs for those business. But for our clients, that will be quite a significant cost. The real impact, I guess, of that change will be on for those that can, is that they're more likely now to take dividends rather than salary. And obviously, over the period of sort of recent years, the differential tax impact between salary and dividend was largely closing. But with this additional NIC cost, now I think we'll have a drift back towards director shareholders remunerating themselves by dividend, again changing behaviour and changing the tax take. One of the things that I was expecting that didn't come was I was expecting more of a realignment between dividend tax and income tax, and that has been something that the government has sort of proffered in the past. I'm not sure that that is completely off the table. Whilst the Chancellor has recently said that there will not be a budget like the one that we've had recently, I still foresee that there will be some movement that will correlate sort of dividend tax a lot closer to salary. And again, that comes back to my point, which is if you are money boxing money in a company and there is no sale in order for you to release that, I would really be thinking about how you extract that and extract it at like a rate of today that is known. So we know what the dividend tax is, and we can benefit from it being lower than salary and dividend. But also think about other things. I know we'll come back to pensions and the fact, obviously, that they've also been drawn into sort of the IHT net. But those employees that are more likely moving towards retirement age and possibly closer to taking a tax-free lump sum, switching increases of salary to pension contributions would obviously be beneficial, particularly if those companies are also passing on the NIC savings to the employee. I think we will definitely see a shift in salary sacrifice. So certainly looking at salary sacrifice for pension contributions, but things like electric cars, I think more companies will look to try and be a bit more innovative in terms of rewarding their employees. And I expect we've always done a lot of approved and unapproved share option schemes at Cowgills, but I'm imagining that actually we'll see a bit more of an uptick, because when it becomes increasingly expensive to remunerate key employees, there are different ways that we could possibly lock in those key employees and also drive value and get them more on an exit than if we were just paying them bonuses. I suspect that alongside EMI options that are always attractive and will become more so, things like CSOP, which are all whole company share schemes, I think we'll see an increase in those, because there are a lot of tax advantages to approved share schemes where you might be able to give shares without any income tax or national insurance impacts. But and then those employees are able to sell shares, trade shares really, as long as they keep them for the initial 3 years, if they then sell them, they will benefit from rates of capital gains tax. And obviously, yes, it's gone up, and let's say the maximum rate is 24 on the disposal of shares, it's still obviously significantly better than a 45% tax rate and a hike in the national insurance rate. So that is definitely something to think about how we might change the way that we remunerate staff in order to make it more tax efficient for businesses. So I'm conscious that we've all spoken for a long time, and this is trying to be an interactive exercise. So we did have a couple of questions which we've largely covered, but if anybody's got anything that they would like to ask the team, if you want to put it in the chat box, we'll try and address it. One of the questions that we had previously was in respect of stamp duty, and one of the things that obviously was the measure that came out of the budget was this additional stamp duty land tax rate on additional acquisitions of residential property, which aren't the principal private resident of the purchaser. And obviously we'd had changes to multiple dwellings relief. So I wanted to ask you, James Greenarch, if I may, because obviously you deal with a lot of our property and construction clients, is with the rise in stamp duty land tax rates for acquisitions, are there ways left to mitigate SDLT on residential property investment?
The simple answer is not many, Lisa. Because we lost the multiple dwellings relief back in April, so that was the previous Chancellor. So that was where if you bought 2 or more residential dwellings as an investor, you could apply an average rate of stamp duty. So in simple terms, that meant that if you were buying a load of residential properties and they were each worth less than 250k, the maximum rate you were going to pay on it in stamp duty terms was 3%. So that went back in April, and with this additional, the additional surcharge has now gone up to 5%. So you are looking at 5%, but it's worse than that effectively, because with multiple dwellings relief gone, if you're buying 2, 3, 4 residential properties in one go, it's classed as one transaction, and therefore you'll pay 5% on the first 250k, and then you'll pay an additional rate, 10% charge on the price between 250k and 925k, and then 15% over 925k. So that means that multiple purchases of residential properties is extremely expensive from a stamp duty perspective for a buy-to-let investor. The one positive left is that there's a rule that wasn't changed in the recent budget, and that's if you buy 6 or more residential properties in one transaction. So typically, if someone's buying off a developer, they've reserved a load of off-plan flats, and they're buying it at 6 or more in one go, you can elect to say that that is not a residential transaction. You apply the commercial rates of stamp duty land tax, and that means effectively you'll only pay a maximum of 5% on the total sale proceeds. The commercial rates of stamp duty are 0% up to 150k, 2% for 150 to 250k, and then 5% over 250. So those apply to normal commercial properties. But there is that relief whereby if you buy 6 or more resi properties, you can still access that rate. So that effectively it leaves, buy-to-let investments from a stamp duty perspective, it's more favoured towards large transactions, large buyers, potentially funds. But if you've got someone who's into it in a big way, the market might be skewed towards large transactions, and that's probably got a knock-on effect in terms of trying to get some discounts on those large transactions because of the extra stamp duty.
Yeah, it does feel that a lot of our, particularly residential property portfolio clients are under siege a little bit at the moment.
Yes, not just tax. You know, the regulatory environment coming in. There's the renters bill coming in. They're not in a great place from a regulatory perspective.
No.
There's trouble coming down the line. It's just making it more difficult to evict problem tenants. So yeah, not great news for that sector.
No, thanks, James. I just want to pick up some of the questions that have arrived in the chat. So, any thoughts on sheltering pensions from IHT? It was a funny one. Obviously, the bringing pensions into the IHT net has had a significant impact on the IHT estate of certainly our clients, where somebody might have had a reasonable estate with a reasonable IHT bill on it. If you've got a pension of £1 million, suddenly you've lost 40% of it. And in some respects, it's even worse than that, because obviously the rules are still in play, which mean that on any drawdown for beneficiaries, they are still taxed at their effective rate of tax. So if a pension has been left to a beneficiary who's a higher rate taxpayer and they withdraw that, the effective rate of tax on that pension is actually 67%. So it's gone from zero to an eye-watering 67% if that person draws it down. The advice, obviously we're not IFAs, and I don't want to stray into areas that aren't necessarily our field, but advice that we've given clients in the past is actually you leave your pension to last. That is sort of your emergency exit, because that is the most tax efficient asset that's in your estate. That advice will significantly change now, because you've actually got more control over the things in your estate and giving them away rather than your pension. So instead of leaving it to last now, you'd be looking at drawing down, gifting your tax-free amount potentially, and then gifting what else you can in your estate, and then using your pension in order to sort of whittle it down as much as you possibly can to escape the significant tax charges. So I think not necessarily any thoughts on sheltering pensions from IHT as such, but more about actually it's going to become even more critical for clients to be planning what happens in their estate. I think certainly for companies with the additional changes on BPR, it's a sort of, it's really piled in on IHT. Things like insurance are going to be absolutely key. So IHT insurance, whole of life cover, which I'm not a big fan of because it tends to be extremely expensive, but maybe cover for a 5 or 10 year window that allows you to gift in that period and do some manageable gifting, which sort of underpins the IHT liability in the estate. That is going to be really important. I think for companies where you have multiple shareholders, things like cross option agreements and company insurance that will allow those shares to be bought back from the company. My worst fear, and this was the whole premise of sort of business property relief, was that actually if you die unexpectedly, you're suddenly in a fire sale, because you've got to find the tax on the value of those shares, which will have significant effect on some of these previously quite stable businesses where there will be a need to find liquidity. So I think protecting yourself in terms of IHT insurance and making sure from a corporate perspective that you're covered, that would be a very good move to go forward. But in terms of sheltering pensions from IHT, unfortunately, I think any of that is off the table now. Michelle, do you want to just
sorry, Lisa, just one point on those insurance policies. As those develop, a key thing there is going to be what's the value of your company.
Yeah.
To determine the level of cover, and having regular valuations, independent valuations, I think will become a big feature of insurance policy sort of negotiation and looking at the premiums.
Yeah. And inevitably, in some cases, there's always going to be a shortfall, isn't there, James?
Yeah,
That will
and
need
that,
to be
and
made
that's,
up by the company. Yeah.
yeah,
And that's worse, isn't it? Because if you need money out of the company in order to pay the liability, you've got
you're
a
in the
double
fire
layer
zone.
of taxation because you're extracting potential cash that's going to be hit by a dividend, and then you've got to have to pay the tax using that income. So, you know, all round it's not great. And
It's bad,
structuring
yeah.
those cross option agreements, possibly to go into trust and not go into the company again, there's something, you know, you can be a bit smarter about how these are structured in order to make sure they are as tax efficient as possible. Michelle, do you want to pick up on the offshore stuff? So leaving the UK, which obviously we've done quite a bit of recently with people migrating to Portugal.
Yeah, sure. Obviously, we're still trying to digest the 103-page technical issue. So because there's a lot of detail on there, but obviously, despite all the speculation on the proposed non-dom changes and Labour saying they would water them down, they proceeded with the full-scale reform. And whilst she says it's going to be internationally competitive, I think we need to wait and see on that. But from 6th of April 25, the current domicile-based regime is going to change to a residence-based tax system. So we are going to obviously be looking at the statutory residence test as opposed to where you were born, where your father was born, and where you have ties to in that respect. There are obviously transitional provisions, and we are still awaiting detail and so, you know, obviously we wait to see what the final version will look like. But there is various provisions that have been brought in terms of a 4-year foreign income and gains regime. So the remittance basis of taxation is going to be abolished, and this foreign income and gains regime is going to be introduced. But that's only for non-DOMs and people who've been non-res in the previous 10 tax years. And you've got to claim that on your tax return, etc., etc. And in terms of non-DOMs who are in the UK, there is a temporary repatriation facility, which is going to be introduced for individuals who have previously claimed the remittance basis, so they can remit foreign income and gains that have arisen prior to April 25, but they're going to be able to pay a reduced rate on that. Now, obviously, there is a lot of detail behind that, and that is a key area that obviously, if anybody is looking at, really does need to get specific advice in relation to that, because obviously there's rebasing, which has been brought in from April 17 when we thought it would be April 19. So, but all of that in terms of income and gains for non-DOMs is changing, and also inheritance tax for non-DOMs is a big area which is changing. So ultimately it's going to follow those new residence-based regimes, and so an individual's worldwide assets are going to be in the scope of IHT if they've been UK resident in at least 10 out of the previous 20 tax years. So there's a new classification of individuals such as a long-term resident, and obviously part of tax years of residence are going to count to the 10-year total as well. So that's obviously something the non-DOMs need to consider as well.
I think it's still right, and I haven't seen anything to the contrary, Michelle, is that, you know, if somebody wants to leave the UK and they are looking to realise gains or a dividend, you know, our advice has always been, if you leave on the, let's say, the 1st of April and you're out for your tax year, if somebody's looking to dispose of an asset, they leave on the 1st of April, but they sell on the 10th of April. That will usually, if that person remains non-resident, that will be outside the scope of UK tax. If that person comes back in and it's a 5-year window, if that person comes in that 5-year window, then that gets caught. So your gains will be reassessed, and that's similarly true for dividends. I haven't seen anything where that's changed, but as you've said, Michelle, there is more of a tail now, isn't there? So it's not just you've always had to look at, am I resident for tax purposes and what are the implications of that, or am I domiciled? And the rules have been very different, and there's been different deadlines for when that sort of tax might bite. I haven't seen anything that changes that. If you are out for the whole tax year and you are not subject to UK residential taxes, then as long as you are still out for 5 years, you will be you will escape gains on that. But obviously, you need to think about your IHT position there, because actually you might still be caught by the IHT regime.
Yeah.
Will there be any changes to somebody selling if they choose to leave the UK, given the changes to the non-dom? I think you've covered some of that, haven't you, Michelle? And then Nigel, on a trust set up in 2023, will BPR remain at 100% on debts within 7 years for IHT now or halved?
Yeah, so presumably the lifetime transfers made before budget day are going to continue to benefit from the old rules, as will any gift or, chargeable lifetime transfer. But we have a consultation on trusts and BPR, etc. So that detail is going to need to be confirmed. But we had a conference with the Society of Trust and Estate Practitioners last week, and they seem to imply that basically it is going to fall under the old rules. But we wait and see what the consultation comes back with.
That's great. I think we're at the end of our hour now, and so I'd like to thank everybody for joining today. I hope you found the conversations useful. Obviously, if there was anything that we didn't cover that you want some clarity on, then please don't hesitate to get in touch. What we will be doing is sending out the recording to all of the participants. So if you're desperate enough to watch it again, please do so. You've got that opportunity. But if you have got any specific questions that you want to come back to any of the team that you've heard from today, then please just reach out. On that recording, there will be details of the contact details for all the people that have been on the seminar. So thank you for your time this morning. I hope you found it useful, and we look forward to speaking to you all soon. Thank you.